Okay, good morning, everybody, and thank you for joining us here at the GRC Solutions webinar on global regulatory challenges and compliance best practice. Before I move into the content for the morning, and this will take overall about an hour, with probably about 45 minutes or so of content, also leaving a bit of room for questions as we progress and at the end. Just a couple of sort of admin points. As we progress, there is a Q&A box, so you can add questions. They can be then, they are anonymized, so you can ask questions as we go. So please feel free, if anything pops up, just to type that in and I'll try and answer as we go or when it's appropriate. And there is also a chat box, so if you're inclined, you can type in that chat box, and typically all people can see that, so other attendees on the webinar would also be able to see the information that you put in there. So if you want to do that as we progress, feel free to do so. We will be recording the webinar today, so we'll be posting this on our website and on our YouTube channel upon completion. And we'll also, for those of you that would like them, we're able to distribute a PDF copy of the content that we're going through, so we can do that post-webinar as well. In terms of what we're looking at today, we're going to focus on a few different areas, so a few key points of sort of issue, concern, things that pop up as problems for people currently in global compliance. And this isn't specifically focused on one industry sector, so most of the content we're covering will focus on a variety of sectors. The first thing is to look at what we describe generally as behavioural compliance. So this is looking at the way people behave and interact within an organisation. So this is a really big sort of hot topic for regulators at the moment, looking at the conduct risk, risk culture, and behavioural compliance side. So how are we setting our risk culture? How are we managing conduct, working to improve these at organisations at the micro and also the macro level? The second thing will be to look at some areas around the growing trend and issues and threat from bribery and corruption, including some areas of economic and white-collar crime. So regulatory and legal fines for fraudulent conduct for areas around bribery and corruption have gone up significantly over the last few decades. We'll look at a timeline a bit later, and there is significant news again this week around different parts of the world to do with bribery and corruption. So we'll look at some statistics on that front as well. We'll also, towards the end today, look a bit at some of the technology solutions which are coming up with a view on helping organizations. So some of the challenges and some of the opportunities, including things like regulatory technology, but also some of the benefits and threats generally from the industry and what people could be doing a bit more of, because statistics indicate that a lot of organizations are still pretty far behind when it comes to use of technology and technology adoption in their organization. So the first thing I wanted to look at was, or is the state of compliance. How are we looking at compliance now? What does it mean? And where are we? And I think it's fair to say that compliance is something we never finish. It's something we consistently move on and progress, but we never get to an end point as such. This chart is from the Asia Pacific Fraud Survey conducted by EY. So the data was released a couple of months ago around April, and it's a good way of looking at some of the biggest risks people feel they face. So partly there's the macroeconomic side, so things like slower growth, and there's also the political instability side. But for us, one of the biggest areas we will be looking at is to do with the regulatory side. 59% of respondents, and this is nearly 2,000 respondents, said that increased regulation in their sector was particular concern for them moving forward. We have an interesting ongoing conversation or dialogue with some of our clients here in the Asia region, with this view of there being a significant increase in regulation. And for the most part, I don't think that's particularly accurate. Now, there is some element of truth here in certain places, but actually what we're seeing in a lot of jurisdictions is not so much an increase in regulation that's being put out for people. It's a much greater level of enforcement and supervision of existing regulation. And I think that we're seeing a lot more typically than we are seeing new regulation come out. Now, there are exceptions, of course. So here in Singapore, there's a move to produce a new bill for cybersecurity, for example. We have reviews and revisions to some of the law in places like Australia, updates in parts of Europe as well. So, for example, GDPR, which is coming out or will be enforced in the middle of next year. But I think more it's the trying to get up to speed with existing regulation that we have. What does this look like then in practice? The reality is that the number of regulatory disciplinary cases we have seen and are seeing has increased and has been increasing significantly for a period of time. So a significant sort of change in volume in terms of those cases that appear. It's hard to know always whether we're seeing just generally more cases coming up or whether there's better media coverage of them. As an example, we were looking at a case for one of our clients recently, actually in the US, to do with fraud on the insurance side. And whilst we can find quite a lot of information relating to the case itself, finding an outcome of that in terms of what actually happened is quite difficult. And we'll look a bit later at a bribery case from Malaysia, and it's similar. You can follow a chain all the way to where the case gets to court, and then really after that, very little. The amount of fines by regulators has been increasing. I think probably at the moment we've gone past the final tipping point in terms of the ultimate area where it will start dropping again. By and large, I think people are aware that the system of fines in a lot of cases hasn't really had the desired outcome. So whilst fines have been levied to huge amounts, behaviour hasn't changed significantly in lots of organisations. And again, there are exceptions, but we've seen significant fine increases over the past 15 years or so. There's also an increased regulatory expectation on organizations, and this applies again across all different industry sectors. So what we're seeing is a real need for people to be much more cognizant, not just of legal requirements, so the letter of the law, but also the spirit of the law, what that actually means in practice, and also not just for the organization, but for the community at large. So there's a real huge drive at the moment on things like governance, particularly ESG. So, we've had two different corporate governance indices released this week for Asia, one for the Asia region and one in Singapore. And there's a massive focus on the environment, social and governance factors. And that's driven by issues we actually see in real life. So, for example, here in Singapore, a huge problem that we've seen over the last few years has been transboundary haze caused by people in certain jurisdictions using things like slash and burn agriculture for things like palm oil production. And that's leading to a huge change or need for change around environmental compliance. What does this mean then from the point of view of conduct risk and risk culture? And something we tend to do is rephrase conduct risk. Regulators, by and large, haven't been very good on purpose, I think, at explaining exactly what they mean by conduct risk. So we tend to look at this from the point of view of behavioural compliance. Now, we would describe this broadly as things including the risk of unethical, inappropriate or unlawful behaviour by management or by employees. So this could be deliberate or accidental conduct, including things like conduct caused by inadequacies in corporate practices, corporate policy, and corporate training. This quote here from KPMG, I think, is pretty interesting. The idea that we want to drive organizations from profit-focused, profit-driven to one where customer centricity is at the heart of improving trust. Trust in certain sectors of industry is at an all-time low caused by a variety of factors. That's true in things like financial services, that's true in media and public relations as well. Then we have other sectors that have had trust issues for a number of years, for example, things like real estate. When we look at this from the consumer focus side, and for us as an organization, a big drive we've had amongst our client base is to start looking and being much more aware and spending time focused on outcomes from a regulatory and a compliance perspective. So we'll be looking at things that an organization could engage in to cause problems to consumer protection, to competition, or to market integrity. So a risk to the fair delivery of customer outcomes. This is tied to the product life cycle. So there was a really interesting chart produced in 2013 from the FCA in the UK that actually listed, I think, 6 or 7 stages specifically of the product life cycle and how this ties to conduct risk factors. Other groups, other regulatory groups have produced information as well on what this means. And in terms of that product life cycle, it would be broken down typically into areas such as product design, T's and C's, the sales process. Of course, a lot of organizations still KPI driven on the revenue generation and the profit side, claims, complaints, and product governance. Here, issues would be things like priority of profit over ethics, so commercial interests over consumer interests. Also, too much of a tick box approach to compliance, so something that's overly legalistic and doesn't necessarily follow the spirit of the law. The slide we're looking at here is from the same report I mentioned from the FCA in the UK from 2013. And apologies that it's a little bit blurry, but I think it's pretty interesting in terms of 3 key areas broken down into 9 specific segments of what causes conduct risk. Some of these are pretty interesting. I think particularly the orange box at the top, what we look at is the inherent factors. So looking at things like the cultural intelligence side, so biases and heuristics, things like inadequate financial capability, so lack of knowledge amongst consumers in the market. There are also the red factors, the environmental side, so things that happen sometimes outside of our market, so economic trends, changes to policy and regulation and law, and technological developments, some of which we'll come back to a bit later. Then on the purple side, we're really looking at often things that are taking place internally in business, organization, and industry as a whole. So conflicts of interest, and this is something that really I think a lot of organizations need to address a lot more fundamentally. We see so many cases of conflict of interest still. Culture and incentives, and that's something that regulators, including in this part of the world, have mentioned again recently in terms of the whole mantra of the tone from the top is not sufficient. It doesn't mean anything if organizations are just going to talk the talk, they're not actually going to do anything. And then the ineffective competition side, where we actually need competition to challenge organizations to be acting in better ways. ASIC in Australia have come out with some pretty interesting information on conduct risk. So again, they phrase this as inappropriate, unethical, or unlawful behavior on the part of organizations, management, or employees. So this can be caused by a number of things. Could be something that's done actively, could be something that's done as what we look at as a mistake. And what I think interesting here is the outcome side. It can have significant ramifications. So a big impact for an organization, for its shareholders, clients, customers, counterparties, and the financial services industry. ASIC did a survey in 2014. They surveyed 21 investment banks operating in various locations, so the major Australian banks, and then primarily European, US, and Asian investment banking groups. The survey looked at the appetite, attitude, and approach to conduct risk, and following that, they came out with their 3 C's of conduct risk. So these are communication, challenge, and complacency. So communication of conduct needs to be clear, concise, proactive, and regularly reiterated. And what we're starting to see now are things like micro learning, so compliance bites learning, instead of what we look at as annual or 12-month refresher for content for individuals. Communication strategies need to be meaningful, so they have to have bottom-up validation. We should be getting information and feedback from all of our staff, from most junior to most senior, and from the outside in, so not just a message from the top being driven down. It needs to be linked to the importance of the reputation of the individual. It should be linked, if you have them, to things like core values, your code of conduct, the ethical viewpoint of the organization. For the challenge side, organizations need to challenge existing practices. Is what we're doing currently appropriate in terms of the way that conduct is being conducted, in terms of the behaviors we see from an ethical standpoint across the organization? There's also the view of fostering an environment where employees are encouraged to speak up, to escalate concerns, to come up with new ideas and new positions in terms of how we might do something. There's also an issue we see in business on the complacency side, where people assume that because something hasn't happened yet, it never will happen. We had this with an organization I was dealing with in the last couple of weeks, where one member of staff's view was that we know everything about our clients. therefore there is no risk of anything bad happening, which I think is a slightly misguided viewpoint and to some extent quite a dangerous way of thinking about things. This needs to be continually reviewed, enforced, and validated. So, if you look at recent information that's come out around these areas, the whole thing that follows from ISO standards, it's not just setting the standard; it's the review and the improvement as time goes by. We've had some pretty interesting information that's come out, primarily from two departments in the US this year, with regard to the analysis of compliance programs, so how they would be evaluated. And this first set of information comes from the Department of Justice and was from February of this year. This is pretty useful in the sense that there are 11 very clear points here that the Department of Justice in the US would look for to evaluate a compliance program. And I think that these would be applicable anywhere in the world. So the first point here, again, mentions conduct. So analysis and remediation of underlying conduct. This isn't a specific issue to one place or one industry. It happens, universally. There, of course, is a reference here to the middle and senior management side, as well as resources and policies. So a lot of these things are areas that we would expect to be in place generally in most organizations. Shortly after that, there was further information released from the US Department of Health and Human Services. This was from their Office of the Inspector General. And again, obviously, this is focused on particularly healthcare, but this is pretty interesting in terms of a set of points that largely mirror what came out from the Department of Justice. So again, looking at policies, procedures, looking at things like program administration, communication, education, and training. So a lot of the points were similar across those two areas. We've seen consistent information coming out from the Department of Justice. There has been a change that some of you would have seen in that organization in terms of the lady that was in charge of what we'd look at as their compliance side, left the organization in the last couple of months. And more information has come out about her tenure there, which has been pretty interesting. And there's a good article that came out from Thomas Fox this week, who's a US-based lawyer and compliance commentator, which gave a good indication of changes that she had helped create that will be ongoing in that department, even though she has moved on. The intended audience for these two bits of documentation, so from the Department of Justice and from Health and Human Services, are actually slightly different. So the Department of Justice information was drafted primarily for internal use, whereas the Health and Human Services information was designed as an external tool to be used across the industry. We would link this in terms of the view to elements of the ISO 19600 compliance management standard. So I just mentioned a few moments ago the view of the continued updating, monitoring, evaluation, and improvement of compliance programs. And I think this is a great way of looking at it here. Develop, implement, evaluate, and maintain. So plan, do, check, and act. PDCA, plan, do, check, and act is followed in nearly all management standards that come from ISO. If you haven't seen this information, I would definitely recommend you look at it. Again, there are about 11 points here that are listed as what organizations should be doing, firstly in the top half to establish, and secondly in the bottom half to improve corporate compliance programs. A lot of these most organizations will be doing to some extent. It's often then a case of how can this be improved over time. This would tie into what we would look at as a model of regulatory or a model of compliance development, going from what we would perceive to be at the bottom in the red side, a sort of relatively reactive, so static or tactical approach to compliance, up to the top right where we would look towards proactive, dynamic, strategic compliance strategies. So not every organization goes through every phase as it's listed here, and these can happen in different orders. But there are certain things that would categorize each element of this diagram. So in the startup phase, organizations would primarily be still looking at relatively simple, easy to implement measures with things like punitive enforcement and a focus really on technical rule breaches. So again, looking more at the letter of the law than the spirit of the law. In the crisis phase, we would have a bit more of a reactionary response to an emergent problem or set of problems. There could here be unexpected consequences between some of the problems that occur here compared to what we had in the startup phase. We tend to here be a bit more politically or opinion driven internally in an organization. In the expansion side, we have a more proactive view of compliance within the organization starts setting significantly clearer objectives for our GRC program, start looking at things like values and extending compliance as a broad term into less core and more fringe areas. So moving away from just ticking box regulatory compliance towards actually looking at what we can do as a company in other areas that might apply for us. Things tend to become a bit more expensive and bureaucratic in this phase. This is where we might start expanding the number of people, the number of policies, the number of rules, training courses, etc., within an organization. Following that, there's a recognition that this cannot continue exponentially. We have to get to a point where we start looking at becoming a bit more sustainable, and so there's an emphasis to look at positive behaviors from individuals, not so much enforcement of specific rules. The idea in terms of where we want to get to, and I mentioned this a bit earlier, is a focus on broader systemic outcomes. So how can we get to a point where we incorporate an understanding of the community, the purpose of regulation and compliance, social and economic effects, so things like those ESG factors we mentioned. At this stage, we would start seeing more creative methods of compliance, as well as having different criteria for success in enforcement. So instead of having, we've done a good compliance job, how do you know? Well, we haven't been fined. Actually looking at beneficial outcomes on the financial and the non-financial side. Of course, institutions know some of these areas, and we're aware that senior management do play an important role with regard to conduct in an organization. This content is taken from a speech given a couple of weeks ago, or last week, sorry, by the monetary authority here in Singapore. What I think is really important is actually the second line in the first paragraph. In terms of senior management approach, and they mention here tone from the top, they then went on to say that it must also be translated into real actions throughout the organization and not just remain as talk from the top. Strengthening risk culture, governance, and controls will go a long way towards fortifying our defences, but there is more we can do. We can work together and work smarter. And I think that's pretty important. What we're seeing in a lot of places is a much greater interaction between compliance and regulators. I said we would look or take a look at some elements of bribery. If anybody follows global compliance or news in this area, there's been an awful lot happening in the last few years, but currently in the last few weeks it's been pretty busy. And we would look at bribery as inducing a person to perform improperly a relevant function activity, or rewarding a person for the improper performance of a function or activity. The first definition here is from the UN, and the second is from the UK Bribery Act. A study was conducted a couple of years ago here in Singapore by a law firm called Eversheds, and they came up with some pretty interesting information. So in the first section here on the left, 500 board-level executives were asked how the organizations managed bribery and corruption risk, and the outcomes were pretty fascinating, I guess. So the numbers here I think are quite shocking. Half of the board members in Singapore felt that their anti-bribery and corruption policies are ineffective. Now that raises a question for me. If you're a board member and you think your policy is ineffective, you're not doing a proper job as a board member. That's the first point. You should be challenging that. Part of the role of a board member is to review and sign off, approve policy. Why are they approving policy that they think is ineffective? Less than a third said they understood their anti-bribery policy, which again is pretty shocking. And only 4% felt that they'd received sufficient anti-bribery training. So pretty damning statistics in many respects with regards to what's happening at senior management levels. And again, this comes back to the idea of tone from the top. In organizations, and this is pretty broad, this is 500 board level executives, we're being told one thing, but actually when it comes to doing the walk, that clearly isn't filtering through in the right manner. I won't go into too much detail on following cases, but it's worth pointing out FCPA. We've got here the legislation that keeps on giving. This goes back to the late 70s, so about 1977. AstraZeneca fined in the last couple of years for offences going back to 2005. So they paid 5.5 million to settle investigation into alleged bribery at their Chinese and their Russian units. So payments were made, so gifts and other benefits were given to state employees in return for having increased prescriptions. Of course, healthcare pharmaceuticals has been at the forefront to some extent of bribery in the last few years, of course, looking at things like the GSK case. And this is Analogic, an organization that paid a fine of around 3.4 million. They also paid disgorgement and interest charges, and that's quite common in cases at the moment. So significant fines here. They related to about $20 million here in improper payments to Russia and other countries. So it's actually a Danish subsidiary of Analogic. Significant in terms of the reach of US legislation, so the extraterritoriality, and also the size of some of the fines and the punishments we've seen. And we'll touch in a minute on an ongoing case, which is the Walmart case, which is very substantial in terms of the size, but fines, it seems to be organizations having a bit more success in reducing the level of their fines over the last sort of 18 months, partly due to the FCPA leniency program. There's been an ongoing case in Malaysia as well. So there are, some of you would have seen a couple of different cases, a variety, but there's been a significant ongoing case which came up towards the end of last year. The image you can see here is a police image from Malaysia, from the Sabah State Water Department, of assets that were seized. So this includes jewelry and what you can see in the foreground and the background of this image, which is piles of hard cash. This is a case that came to light in October. One of a number of cases being looked at by the Malaysian Anti-Corruption Commission, where they discovered that a couple of senior officials had taken what's estimated to be about 60 billion of funds they diverted from $1.1 billion project. So this was designed to improve water distribution and sanitation in rural parts of Malaysia. You can see here some of what they seized, and it's incredibly varied in terms of what it is and sizable. So over $12 million in cash, nearly 14.3 million in domestic bank accounts, and 7.1 million in foreign accounts, and that was primarily in Singapore. 9 luxury cars, $119,000 of handbags. There were 2 people and then a third involved in this case, and they went to court in December, and they all pleaded not guilty. Unfortunately, there's not been a lot of outcome from this since that we can find that gives an idea of how this case has or may be concluded. There's been a number of significant cases ongoing in Malaysia following this as well. There are, of course, a number of international anti-corruption measures, and for most organizations, depending on where they are, we would have concern around things like the UK Bribery Act and the Foreign Corrupt Practices Act. I won't go through explicitly all the details here, but there are significant differences. I was speaking to an organization in the last week that's a UK listed PLC, but for some reason training their staff using US content which is aligned to the Foreign Corrupt Practices Act. Now, whilst it's a good idea to be training employees, there's an element here going back to that conduct and behaviour side of making sure it's relevant and fit for purpose. There are significant structural differences between those 2 pieces of legislation. So the first point here in the difference is, the UK Bribery Act covering private bribery, whereas the FCPA does not. So the FCPA is really focused exclusively on bribery, active bribery of government officials, whereas the Bribery Act covers both active and passive bribery and covers the personal private side as well. So it's important that this has to be tied to what you do as an organization, your local requirements, as well as international requirements you might fall under. A good example of that at the moment, again, is GDPR, so the General Data Protection Regulation, which will come into force in the second part of next year in Europe, but that affects any business that has interactions or dealings within Europe. So even for GRC Solutions, we have clients in that region that will affect us. So we have to be very aware of these type of global requirements. It's not good enough, therefore, to be training people just on the local law in many of these cases. Earlier this year, so in March, the US declared, the Justice Department said that they would extend what's been known as a leniency program for companies that disclose bribery. This was first announced in April 2016, and it's been announced that this will be extended, so it should have expired on the 5th of April. This has been viewed as being pretty successful, hence the reason they will be extending it. So companies that came forward during this period of time and disclosed that they had issues around bribery and corruption included pretty large organizations like Akamai Technologies, Johnson Controls, and also Nortec. Compliance has got and is continuing to become a little bit more complex. This data is actually from a few years ago, from 2014. Um, the reason I've included this is looking at issues around bribery at the moment. A lot of bribery offences occur due to problems with third parties, and this is from a group called Alex Partners. 2014, fewer than half regularly conducted due diligence on third-party agents, and that's a pretty low number given the risk they pose for regulatory and legal breaches. There's also a great discrepancy around the world in terms of what organizations do. So 1 in 5 respondents at European companies said their industry are exposed to significant risk on this front, compared with 40% of respondents from US companies. I think both those stats are quite low. I think in a general sense, they should probably be a little bit higher. What's also important here is that I think a lack of due diligence conducted in large parts of the world on your own employees. So we have things like KYC, know your customer, and customer due diligence in lots of industries. But there's been a really slow uptick of 2 things. One is KYE, so know your employee, and KY3P, so know your third party. Those things are starting to improve, but by and large it's taken a long time to get there. And I think it's fair to say that more needs to be done on both of those fronts from organizations around the world. This is a useful timeline, and I'll point out in a minute a couple of things that are not quite accurate with this, but it's a useful timeline in terms of looking at how the anti-corruption regime globally has really changed. So going back to one of the first bits of law, the Foreign Corrupt Practices Act from the United States, all the way through to 2017, and you can see big gaps here. So for large periods of time, not an awful lot happened on the corruption side. FCPA is a good example. People think that the US have been enforcing FCPA as it is for decades, and they really haven't. It's been in the last sort of 12 to 15 years they've really taken a much stronger view of it. So the Siemens case is only 9 years old, and that was at the time the biggest fine. So it's pretty recent that things have started picking up. I mentioned that there are a couple of errors here. One is Transparency International, 1995. That is true. That's when the Corruption Perceptions Index was launched, but TI actually dates back originally to 1993. If you follow this timeline through, you then start seeing some quite significant things happening in the last decade. So 2008, I mentioned that fine for Siemens. Here it says 2011, the CPI launched. That was actually in 1995. And of course, 2011, the UK Bribery Act came into force. We then had the first prosecution under that in 2013, and they have been picking up speed. 2014, we saw a very big investigation into Rolls-Royce, and there are some ongoing elements of that in the UK with the Serious Fraud Office and the start of Operation Car Wash, so the Brazilian government scandal around Petrobras. 2016 and 2017, you can see there's just a huge growth in the view of anti-corruption, and this is a handful of significant cases. There are many more that have come out. Unioil, Panama Papers, of course, and on the Panama Papers, we've seen this week the Prime Minister of Pakistan, who's been found guilty of offences and has had to step down from his role. It's worth pointing out he hasn't technically been found guilty of a bribery or corruption offence, but of being dishonest, misleading people. We've had, of course, the Lotte Group in South Korea, which covers what are known as the chaebol, so the family-owned or family-run businesses, and has led to, again, Prime Minister there having to step down, and she's now on trial. 2016 also saw a very significant development, which was the launch of ISO 37001, the first international anti-bribery management system. This can work in conjunction with ISO 19600, which I mentioned earlier, and is a really good idea for organizations to look at. There is a key difference between those two standards, and that is that 37001 for bribery and corruption is a certifiable standard. So you can be certified to be in accordance with the ISO standard, whereas 19,600 is non-certifiable. There are recommendations. You can't be certified technically under that standard. I mentioned third-party risk, and this is dating back to the 2013 EY Asia Pacific Fraud Survey, and 57% selecting the biggest compliance risk as coming from vendors and suppliers. So this is pretty interesting in that under certain law, for example, the UK Bribery Act, you can be found guilty of an offence if a vendor or supplier of yours is engaged in active or passive bribery, even if it's not with your consent. So people, again, have to be much more aware of changing law and the extraterritoriality of that as time progresses. I wanted to highlight this. I think is a pretty interesting statistic here to do with bribery risk. The reason being, this is to do with Generation Y, so the younger generation entering the workforce. 4 out of 5 respondents of this generation would look for another job if the organisation was involved in a major fraud, bribery, or corruption case. Why that's interesting is in the same survey, Generation Y was also the generation most likely to turn a blind eye to fraud, bribery, and corruption within their organization. So there were 3 questions asked as to whether they would be willing to do things like extend end dates or change sales figures to meet targets, and they were the most likely to say yes. So the most likely group to want to work for ethical companies, and also the least likely to engage all the time in best ethical practices, which is slightly ironic. Interesting case that came out in 2014 of a UK firm declaring corruption force majeure to do with a drilling activity. So this was an organization that was partnered with a US firm called Hyperdynamics. The UK company was called Tullow Oil, and there was an investigation that Hyperdynamics publicly announced to do with obtaining and retaining concession rights and relationships with charitable organizations, which potentially violated the FCPA. On that basis, Tullow Oil said they could not continue working on this particular project. Now, charitable contributions can violate the FCPA if they happen to benefit a foreign official in a personal capacity. Drilling had been due to commence in the second quarter of 2014, but they said they couldn't proceed until these activities are resolved. This case then went to arbitration last year. So Hyperdynamics tried to sue Tullow Oil for breach of contract. It wasn't until the end of last year, or beginning of this year, that there was an outcome of this case. So there was an agreement to separate in terms of ending the contract and moving on. So it's quite interesting that this caused a nearly 3-year delay in progress for drilling in this oil block off the coast of Guinea. And significant in that people hadn't done this before, so declaring force majeure for a corruption breach was quite significant. Another organization that was charged by the SEC was a company called Parker Drilling. Again, a pretty interesting case here. Charged under the Foreign Corrupt Practices Act for authorizing improper payments to third parties. So in about 2004, they authorized payments to a Nigerian agent, which totaled over $1 million. We've seen a similar case that came out a few months ago involving Shell, the oil company. Again, involving payments to agents that they say they didn't know about, but evidence seems to indicate they actually were aware of. Now, this payment in the Parker Drilling case was designed to entertain, and you can see we've put that in quotation marks, Nigerian officials involved in resolving an ongoing customs problem. Following this, the company received just over $3 million reduction of a previously assessed customs fine, so quite significant. They were fined and they had to pay back that just over $3 million as part of the penalty that they were faced with. So again, significant in terms of financial impact for organizations. Headline figure from this particular chart, and this is from Alex Partners, and this is a survey of general counsels and compliance officers, is that 30% have stopped doing business with a partner because of corruption risks. So that's nearly a third of companies. That's pretty significant. And when we look at issues why things like inadequate staffing come up as very challenging. Again, variation of policies, so the expense of doing and being in compliance is a potential problem here for businesses. Data like this in terms of building trust, and trust is a key thing that's been mentioned time and again by regulators, by law enforcement, by international bodies, and this is from MIT in the US, the university, looks at 6 different factors for building organizational trust. Some of this research dates back to things including corruption fines, and we'll look in a minute at some specific data regarding the Siemens fine of 2008. Of course, one of the first here is leadership and management, and culture, and those two things are tied very, very closely together. I would say leadership probably even more so than management. Management on the more technical side, leadership harder to categorize. Organizations with good cultural leadership tend to outperform those from a finance perspective than those that are lacking it. Of course, there are then other factors, strategy and structure, as well as systems and product service development. So all these factors work together. One thing I would point out is that the idea here is taking one of these factors out means the system falls apart. They need to work in sync to be a truly effective system. Looking at the Siemens case, as I mentioned, Siemens paid a fine of over $1 billion relating to corruption. They then did some things, and this is from a bigger article, and it's pretty useful because a lot of organizations did similar things. So one of the first is independent investigation, so externally led comprehensive independent people, and a staff amnesty for staff to come forward and report issues that they've seen within the organization. Revision of things like code of conduct and training of employees, so upgrading and enhancing those documents in terms of policies, and then communicating and making staff aware of those. No point having good policy if they're just sat on a file server and no one knows where they are. So some interesting things they've done that are available here in this particular table. One of the biggest ongoing cases in the US has been the Walmart case, which came to light in about 2012 with publication of information from the New York Times. Again, worth pointing out that in a lot of these cases, we find out about them often by good investigative journalism. So the New York Times, people like the Washington Post, and of course the Wall Street Journal, looking at cases like 1MDB, have done a great job in uncovering, and Unioil as well, uncovering some of these issues. So this is from April of 2017 when the FCPA settlement was not confirmed, and this is to do with widespread bribery in their Mexican business line. It's worth pointing out the costs involved for Walmart here have been absolutely enormous. So since 2011, and they started publishing a compliance and ethics update that outlines the costs, they've spent an additional $837 million in compliance costs, including nearly 470 specifically on the FCPA related inquiry. Now, the follow-on from this is that their fine actually was lower than was originally requested by the US government. So the fine they've paid is actually about 300 million, even though the initial request was for 600 million. So a bit of a win there for Walmart. They've increased staff strength for compliance to around 2.3 thousand, with over 500 of those being based in the US. I think something significant here from the leadership and management side is the Global Ethics, Compliance and Risk Committee, which they've instigated. This committee meets more than quarterly. It's met more than 40 times since 2012. And if they think insufficient progress has been made broadly on the objectives and principles, they can withhold cash incentive payments for senior management. Now, that's a good idea, I think, in a basic sense of instituting a level of control over what's happening for the compliance program. As I said, and this is from May from Bloomberg, the penalty significantly lower than was originally estimated. So the thought was that this penalty would be around 600 million and came out closer to about 300 million. So still not insignificant. When you add that to the payments they've already made in terms of improving internal systems, policies and process, we're looking at well over $1 billion related to this specific case. So that's a lot of money. Information here from the World Economic Forum with regard to adequate procedures for the UK Bribery Act. The bold in this text comes from myself, and they say it may be appropriate to require associated persons to undergo training. This is particularly looking at third parties. So I mentioned know your third party. It's not enough now just to be able to say that we as an organization are committed to doing the following. We need to know that vendors, suppliers, agents, brokers, intermediaries we deal with are also skilled in those areas. This has become increasingly significant. As an organization, we are frequently asked to provide records of training for our staff in areas around bribery and corruption when we enter contracts with other organizations. We think that's a good thing. That should be happening. US federal sentencing guidelines are slightly different, but they mention the same thing. We should be conducting effective training and otherwise disseminating information to individuals who are covered by these areas. So I would highlight again that I think this area, in terms of the broader reach for compliance programs, needs to have some element of extension outside of your immediate staff. That can be very problematic. However, there are some good initiatives to help. I would look at something in the initial phase for organizations if they're interested here, at something like Trace International, a Canadian non-profit body that focuses on certification for anti-bribery for third parties. And a great diagram here from KPMG from earlier this year with regards to compliance programs and compliance frameworks. We point out in this diagram that the green is frontline business, and that's half of into what they look at as a compliance program. That's half of it, and that's prevention. Much easier, much better to try and prevent issues from occurring than have to do the two follow-ons, which are detecting and responding. Of course, we have to be aware that mistakes get made. We're all human. There are always chances that something will slip through, but if we can try and prevent as much as possible, that tends to make things much easier further down the line from a business perspective, and actually is more cost effective. It's cheaper generally to prevent issues from occurring than to pay the costs. Walmart, for example, yes, they've spent hundreds of millions on improving staff strength, but that's still not as much as the over $1 billion they're spending on the remedial action, including 300 million in fines. Here at GRC Solutions, we break our view of GRC into 5 different areas for businesses, and the first is the culture side. If you don't have a good culture around compliance, governance, and risk, the rest of this really is incredibly difficult to implement and embed. So, firstly, starting to look at people's mindsets, looking to be genuine about cultural change. This is something that we find as a very significant challenge in many businesses around the world. I would suggest that it's quite region variable. And what I mean by that is I'm based in Singapore. A lot of our business is Australia based. We do a lot of work in Asia, the Middle East, and obviously I come from the UK. Certain parts of the world are much more receptive to change than others for various reasons, and a lot of that is cultural. So if people aren't willing to consider and accept change, that makes things very difficult from a business side. We should view compliance culture from the point of view of recruitment and staffing, so having elements of compliance assessment as part of KPIs and appraisals for people, and also designing our broad governance structures accordingly with regard to culture. So again, factoring in things like the ESG standards that we mentioned earlier, looking at sustainable initiatives. That there's a stock exchange sustainability initiative that was launched a couple of years ago. So these types of things for companies that are really important nowadays and should be built in, should be baked into the organization. They shouldn't be added on as time goes by. The next 2 points we look at are compliance planning and compliance assessment. It's frightening how many organizations we deal with that they do some planning for compliance and they never assess. If you don't assess, you can't spot gaps. If you don't know the gaps, you can't improve on them. So if you don't measure, how can you ever possibly hope to improve? And I think Peter Drucker said that, what can't be measured can't be managed, and I think there's some element of truth in that for compliance programs. We should be looking at, again, outcomes. So not inputs. Far too much compliance is focused on things going in and not things that come out. We should be then looking at the outcome side, assessing, once we do an assessment, where are we covering risks adequately? Where do significant risks still arise? How do we identify and address those? There's also, in the next phase, governance, policies, training, and control. The first thing here is ownership and responsibility. So creating clear ownership for compliance within the business. And that's at all business levels, again, from the front line through to third line of defense. We should understand where compliance, risk, and governance interact, and this should be clearly communicated to the business. Again, shocking number of organizations we go to and people make an assumption for various reasons that risk and compliance are the same, or they're one and the same, and they're done in the same way for the same outcome. And that shouldn't be the case. There are significant areas of overlap. There should be some collaboration, but they're not the same thing. We should have development of policies and training. So we should deploy these. They should be clear. They should be across the business. They should be tailored and specific to the risk that people face in a given jurisdiction and a given job role. And we should, of course, have compliance risk communication. So both at the personal side, at the business unit side, managerial side, and across the organization. Communication is not just sending out messages from the CEO or the chairman. That's not communicating. Communication has to be two-way. We have to be taking feedback from the outside in and from the bottom up. We then, of course, have to monitor to improve. So we need to firstly identify indicators for measurement that we'll be implementing, putting protocol in place to make sure we can verify those, and then respond to changes that need to be made. This could be something like a gap analysis. It could be an internal review or a benchmark review of the industry, something we're looking at to spot weaknesses with things like internal control. What issues and gaps do we face? How can we then look to address those? Things are becoming somewhat easier with new technology. Of course, technology changes, presents great opportunity for business, also provides significant challenge in many cases. We would look at this as being threefold in terms of different organizations who need to work together in a synchronized fashion, to enable consumer protection and provide fair markets. And that would be startups, incumbents, and regulators. So this is what we call the disruptive trinity, and these need to work together. Most startups, most small organizations are not going to be able to take down and destroy an entire market. In most cases, there are exceptions to that. They need to work with the industry hand in hand to provide a benefit. Incumbents equally need to be, in our opinion, a bit more willing to engage startups and newer organizations to see what avenues they can explore to make things better for customers. As a personal example, here in Asia, I think there are about 24 or 25 major international financial services firms in Singapore that have innovation hubs and innovation labs. As somebody that uses financial services and financial products over the last 8 years of my living here, I'm yet to see any significant innovation come out of them. So I'm still logging on internet banking the same way I was 6 years ago. So I'm struggling to see exactly where this innovation is, even though there are myriad startups out there that are doing things in a more innovative fashion. And of course, regulators. Regulators need to understand and add value to the system, in order to make it better for people. So there has to be an allowance of a bit of flexibility. Some regulators do this with things like sandboxes, but there also needs to be a better look on what things can we do that are relatively low risk. So for example, digital identification. And there are great systems out there globally now that allow people to be identified digitally in under a minute instead of a traditional process that can take days to weeks in some cases. We would look at this in terms of what's broadly known as the RegTech side, as the use of new technology to facilitate the delivery of regulatory requirements. And that's taken from a fairly influential paper produced by Deloitte at the beginning of last year. There are a number of reasons why this would be implemented, and we've listed a few of them here. Typically, RegTech solutions are lower cost, so they don't cost as much as going to hardware-based solutions that are sort of put on your server, for example. They are typically much more scalable. There's a great article this morning an organization that's doing work with OCBC here in Singapore called Silent 8, set up by a Polish entrepreneur. And they are now working with a global banking group, a major global banking group, on a proof of concept. One of the reasons being they can scale up what their product is so quickly, and it's a sort of transaction monitoring type solution at low cost compared to what a traditional provider would have. They're more sustainable, they're much less resource intensive, typically employ far fewer people, have much less hardware involved, and a much lower footprint. Cloud-based, so they're simple, they're easy accessible. You don't need to have lots and lots of hardware sat around to deploy, and they are more proactive in terms of identifying risks. The key thing here is efficiency for business. Instead of applying a blanket approach to all risk, if you can see the risk areas and apply resource appropriately in a cost-effective manner, that just makes a lot more sense than trying to cover everybody or paint everybody with the same brush, as it were. Scary level of then adherence to new technology and change. So from a report from this year from KPMG, only 60% of chief compliance officers think that their compliance technology infrastructure hasn't been analyzed to see if it aligns to requirements. About 60% unsure as to whether their technology infrastructure is proactively adapted to align with regulatory change. So this is a lot of people missing that don't know if their technology is actually up to scratch. Something organizations see time and again is that there's not a lack of good technology out there that can be used by organizations, but the bigger risk is not using new technology, it's the legacy infrastructure that most organizations have. Infrastructure that often is so old and out of date and hard to work with that they can't use newer, more nimble providers. Only 27%, so under a third of those polled in terms of those chief compliance officers, strongly agreed that their compliance function has a change management process in place to update changes to law and regulation. That is a frightening statistic. This is something that's mentioned in ISO standards. It's mentioned specifically by individual regulators. It's been mentioned by people like the Department of Justice. Not knowing that a change in the law or regulation has happened to then update policy and procedure is very, very dangerous from a broad business perspective. There are other stats here. I won't go through them all, but I would leave with the bottom one here. Only 69%, so about 70, so sort of 7 in 10 organizations say that they leverage technology to support compliance initiatives. In this day and age, there's really no reason for that. There is fantastic technology out there from all types of providers, so older providers who've been around for a long time, newer technology solutions providers that can be used to support compliance, and they should be. Again, this comes back to that cultural mindset that was discussed earlier. If people aren't willing to change, we won't make significant developments and amendments. From my point, we've nearly hit the end of the session in terms of time, and that's the content I wanted to cover. So I appreciate there's quite a lot in there. I'm happy to stay on the line for a few minutes, which will allow any of you to ask specific questions or use the chat function. I've got those open, so if you do have anything you'd like to raise, please feel free to send questions in. As I said, we will PDF this content, which we will then distribute to you all, and we'll also put a recording of this on our website and YouTube channel, so you could access that and share with your colleagues as you feel necessary. So I'll stay on the line for any questions. If there's nothing specific from you all, I'd like to thank you for your time this morning. I hope you found some of that interesting and useful. And I'll put my contact details up here on the screen. They're also on our website. I'm happy to take questions separately from you. So if there are questions you'd like to send in or you want to give me a call, I'm more than happy to follow up. Okay, so I've just had a question from someone come in, and the question is focused on: can I recommend any compliance technology solutions that are not overly expensive? The answer, two bits of the answer. Number one, yes, absolutely. Number two, it depends in this case what specific area of compliance you're looking for. One of the key variations between what I would look at as the sort of legacy providers of GRC-based technology solutions and, for example, the RegTech organizations, is RegTech firms are typically specialized in one thing. So they're very specialized in, for example, transaction monitoring or in KYC or in digital ID verification. So it depends which thing you would like to do. There are some providers out there that offer broad solutions. So there are groups that will do a whole sort of lot of different areas. And with regards to that question, I'm happy to maybe take it offline. But there's a directory produced by a group called Planet Compliance. So they produce what's called the RegTech directory. So if you look for Google Planet Compliance RegTech directory, there are now, I think, about 300 businesses listed in there, but they break them down by segments. So there are sort of overall GRC compliance providers. There are then specific areas where companies do certain things and they break down what they are. There's also, it's a little bit harder to find, I think, but a page that's online from Deloitte, which is called the RegTech Universe. So if you look for the Deloitte RegTech Universe, that's a smaller listing, but it's pretty good again, and breaks down again by segment what organizations do. So it will tell you the name of a provider and then specifically what that organization does and how that may assist you. So with regard to that question, I'm happy to send those links to you. I'll try and look for your email afterwards, and I can send those over. But yeah, Planet Compliance RegTech directory and the Deloitte RegTech Universe. Thanks for that. I just received your email, so I'll put an email together after the session and send that. Okay, if there are no further questions, then I'll wrap it up there. Thank you all for your time. I hope you enjoyed that and found it useful, and I look forward to speaking to you again on our next GRC Solutions webinar. Thanks, and bye-bye.